There's a guy named Gregory, 46 years old, project manager at a mid-sized engineering firm, earns $94,000 a year. 2 years ago, his company offered him a consulting project that would have added approximately $8,000 in additional income for the year. Gregory turned it down. He had done the math. The extra $8,000 would push him into the next tax bracket, and he did not want to pay the higher rate on his entire income. The logic felt sound enough that he explained it to his wife, who agreed it made sense. His coworker, who took an identical project, netted approximately $5,400 after the marginal tax on the additional income. Gregory netted zero. He made the financially correct decision in his own analysis, and it cost him $5,400. The painful part is not that Gregory was careless. The painful part is that Gregory is not unusual. A 2023 survey by the Tax Foundation found that a significant majority of Americans believe moving into a higher tax bracket means paying the higher rate on all of their income, not just the income above the bracket threshold. This belief is wrong. It has always been wrong. It is wrong in a way that is clearly explained in any basic description of how the American tax system functions. And it produces financial decisions, declined income, avoided retirement accounts, and make withdrawal decisions in retirement that cost the people who hold it thousands of dollars annually and tens of thousands over a working life. Here is what I want to walk through today. The marginal tax rate system is one of the most consequential mechanisms in American personal finance and one of the most broadly misunderstood. I am going to show you exactly how brackets work, why the misunderstanding is so persistent, what specific decisions it distorts, and what correcting it is worth in actual dollars across a financial life. Because the tax bracket myth is not a harmless confusion, it is a wealth-destroying misconception that causes people to decline income, avoid investment accounts, and make withdrawal decisions in retirement that cost them money they will never recover. Start with how the system actually works, stated plainly. The United States uses a progressive marginal tax rate system. The word marginal is the entire key. Your income is divided into segments, and each segment is taxed at the rate assigned to that segment, not at the rate assigned to the highest segment you reach. In 2025, the federal brackets for a single filer look roughly like this. The first $11,925 of taxable income is taxed at 10%. Income from $11,925 to $48,475 is taxed at 12%. Income from $48,475 to $103,350 is taxed at 22%. Income from $103,350 to $197,300 is taxed at 24%, and so on through higher brackets. If your taxable income is $105,000, you do not pay 24% on $105,000. You pay 10% on the first $11,925, 12% on the next $36,550, 22% on the next $54,875, and 24% only on the $1,650 that exceeds the 22% bracket ceiling. Your effective tax rate, the actual percentage of your total income paid in federal tax, is approximately 17 to 18%, not 24%. The bracket you are in describes only what happens at the margin to the next dollar earned above each threshold. It has no retroactive effect on the dollars already taxed at lower rates. This is not a loophole. It is not a strategy. It is the foundational design of the system, and a majority of Americans do not understand it. Here is why the misunderstanding is so durable despite the information being publicly available. It is a labeling problem that activates a specific cognitive shortcut. When people hear the phrase, "you are in the 22% bracket," the word bracket implies containment, a single category that applies to you and your income as a unit. The phrase does not sound like, "you are in the bracket where the marginal rate on your highest dollars is 22%. It sounds like your income is taxed at 22%. The language is imprecise in a way that consistently produces the wrong mental model, and the wrong mental model is then applied to real financial decisions without ever being tested against the actual calculation. Gregory did not look up the marginal rate on $8,000 of additional income at his income level. He applied the bracket label to the decision and concluded the project was not worth taking. The label was doing all the analytical work, and the label was wrong. Here is the historical parallel that makes the systemic dimension of this visible. In the early days of automobile travel, roads in many American states were funded through toll systems. Different toll systems use different pricing structures, some charged by mile, some by vehicle weight, some a flat fee regardless of distance. The complexity was genuine, but it also served a secondary function. Confusion about the true cost of road use made travelers less likely to accurately assess whether a trip was economical or to demand pricing reform. Complex pricing structures have always served the interest of the institution collecting the revenue by reducing the consumer's ability to calculate and object. The American tax code is 70,000 pages long. Its complexity is partly the inevitable result of governing a large economy, and partly the accumulated result of decades of additions benefiting specific constituencies who had every incentive to ensure their provisions were buried in language that general readers would not parse. The marginal rate system itself is not complicated. It takes about 4 sentences to explain correctly, but it exists inside a document of such overwhelming complexity that most people never encounter those 4 sentences in a form they apply to their own decisions. Now run the decisions the misunderstanding distorts, because this is where the wealth destruction is specific and calculable. Gregory's declined project is one example. $5,400 in forfeited income, compounded at 7% over 19 years to his retirement, becomes approximately $20,000 in forfeited retirement wealth. One decision, based on one misunderstanding, costs him $20,000. But the bracket myth distorts a second decision that costs far more people far more money, the decision about traditional 401k contributions. A common version of this reasoning goes, I'm in the 22% bracket now and will be in a lower bracket in retirement, so I should maximize traditional 401k contributions to defer income until the lower retirement rate applies. This reasoning is sometimes correct. It is also sometimes exactly backwards depending on your specific income trajectory, retirement income sources, and the likely direction of tax rates. The person who assumes they will be in a lower bracket in retirement because they will no longer be earning a salary frequently does not account for required minimum distributions, Social Security income, and investment account withdrawals combining to push retirement income into brackets comparable to or higher than their working years. Running the actual bracket math, comparing the current marginal rate on the contributed dollars against the projected marginal rate on the withdrawn dollars in retirement, is the correct analysis. Applying the bracket label without running the numbers produces decisions that are wrong in a specific, expensive direction, and most people making those decisions have no idea the analysis they skipped existed. The third distorted decision is Roth conversion timing, and this one specifically affects people within 10 to 15 years of retirement who have significant traditional IRA or 401k balances. Roth conversions are taxable events. The converted amount is added to income for the year of conversion. The bracket myth causes people to either avoid conversions entirely, believing any conversion will bump them into a higher bracket at devastating cost, or to make conversions without modeling the marginal rate on the specific additional dollars in question at their specific income level. The correct analysis identifies the gap between current income and the top of the current bracket. Any conversion within that gap is taxed at the current marginal rate. Any conversion above the gap spills into the next bracket, but only the spillover is taxed at the higher rate. A person in the 22% bracket with $30,000 of room before the 24% threshold can convert $30,000 from a traditional IRA to a Roth at 22%, locking in a known rate, reducing future RMDs, and creating tax-free retirement income without a single dollar being taxed at 24%. The bracket does not punish the entire conversion, it only applies to the marginal dollars. People who understand this execute strategic conversions in years of lower income that save them tens of thousands in lifetime taxes. People who do not understand this avoid conversions based on a fear of bracket contamination that the math does not support. So what does Gregory actually do? 3 decisions. Decision 1. Calculate your actual marginal rate on any specific income decision before making it, not your bracket, your marginal rate on the specific additional dollars in question. If Gregory is considering an $8,000 consulting project and his current taxable income is $94,000, the question is not, what bracket am I in? The question is, what is the marginal federal rate on $8,000 at my income level, plus my state marginal rate, minus any deductions or credits the additional income affects? At his income level, the federal marginal rate on most of that $8,000 is 22%. His after-tax yield on the project is approximately $6,000 to $6,200 depending on state. That is the real number. The bracket label told him nothing useful. The marginal rate calculation told him everything. This calculation takes approximately 3 minutes using any tax bracket table. It applies to every income decision: overtime, bonuses, freelance work, Roth conversions, 401k contribution level. The 3-minute calculation is worth more than any financial product Gregory could buy. Decision 2. Model your retirement income by bracket, not by income category. Most retirement income projections estimate a total income number and compare it to a current income number. The comparison produces a bracket label and a conclusion: higher bracket now, lower bracket in retirement, therefore traditional contributions are optimal. The correct analysis maps each retirement income source, Social Security, traditional account withdrawals, Roth withdrawals, capital gains distributions, against the bracket structure in the projected retirement year. Social Security taxation rules, RMD amounts, and capital gains rates all interact with the bracket in specific ways that the label level analysis misses entirely. A married couple with $2 million in a traditional 401k, Social Security benefits, and a paid-off house may find their effective retirement tax rate comparable to their working years due to RMD forced withdrawals, a fact that changes the optimal contribution strategy during accumulation by somewhere between significant and dramatic, depending on their specific situation. The label says lower bracket in retirement. The math sometimes says otherwise. Run the math. Decision 3. Identify the Roth conversion opportunity window specific to your situation and act on it before it closes. For most people, the highest value Roth conversion window is the period between early retirement or reduced income and the onset of Social Security and required minimum distributions, typically the years between 62 and 73. In this window, income may be structurally lower than at any other point in adult life, creating bracket capacity that can be filled with Roth conversions at historically low marginal rates. Every dollar converted in this window at 12% or 22% is a dollar that will never be taxed at whatever rate exists when mandatory withdrawals begin. The window is specific to your timeline. It opens and closes on a schedule determined by your retirement date, Social Security claiming age, and RMD start date. People who identify the window and fill it systematically save tens of thousands in lifetime taxes. People who avoid conversions based on bracket contamination fear miss the window entirely and pay higher rates in retirement on forced distributions they cannot control. Here is the number that closes the argument. Gregory is 46. He has 19 years to retirement. If he corrects his bracket understanding today, and as a result takes on 2 consulting projects annually averaging $8,000 each, income he has been systematically declining for years, his additional after-tax income is approximately $12,000 annually. Invested at 7% over 19 years, that stream compounds to approximately $454,000 in additional retirement wealth. The misunderstanding he has carried since approximately his first paycheck has been costing him $454,000 in retirement wealth at the rate of 1 declined project per year. Not through bad luck, not through market underperformance, through a factual error about 4 sentences long that no one ever corrected because the people who benefit from the complexity of the tax code had no interest in correcting it, and the people who could have corrected it, employers, HR departments, financial media, either did not know the misunderstanding was that prevalent or did not consider basic tax literacy their responsibility to deliver. The marginal rate system is not designed to hurt you. It is designed to tax income progressively without penalizing the decision to earn more. Every additional dollar you earn above any threshold is taxed only at the rate assigned to that dollar, never at a rate that reaches back and re-taxes the dollars below it. The system does not punish earning more. The misunderstanding about the system does. And the misunderstanding is correctable in the time it takes to read a bracket table and run one subtraction. Gregory took the wrong project. The math was always on his side. He just never ran it. Subscribe if this corrected something you have been applying to your own decisions. Drop a comment with the last income opportunity you declined because of bracket concerns, and run the actual marginal rate calculation on it. The after-tax yield is almost certainly higher than the bracket label suggested. Most people have never seen that number. Now you have the formula to find it.